This is Bloomberg Crypto, a daily Bloomberg iHeart podcast, and I'm Stacey Marie Ishmael, managing editor of crypto for Bloomberg News. It's Thursday, December 8th. There's often, in any financial market, a reasonable amount of groupthink, sometimes known as the herd effect, or maybe even a mob mentality. There's actually some really interesting research into this. You can check out the paper Bubbles, Human Judgment, and Expert Opinion by Robert J. Schiller for more. Crypto investors are no exception to groupthink, and their in-group behavior comes with a lot of catchphrases, like the famous GM and the infamous have fun staying poor, or the tongue-in-cheek Bitcoin will fix this, where this is basically any social or economic issue you could imagine. In this episode with Bloomberg senior editor Mike Regan.
It's common sense, but humans, traditionally aren't the best practitioners of common sense.
And Bloomberg reporter Emily Nicolle.
It seems crazy. Why would you store your money on an exchange where it's really difficult to get access to it, or you don't own the rights to it? Like, isn't that bonkers?
We'll tackle the mood among the crypto faithful and why some of them are now evangelizing cold wallets. Emily, you have written probably more than any of us on the team about the culture of crypto. And one of the elements of that, I think, is really reflected in the phrase, not your keys, not your coins. For the people who don't obsessively, compulsively read your newsletters on a regular basis, can you just explain what that means?
So, not your keys, not your coins means that if you are storing your crypto with a third party online, typically, there may be something in the terms of service that says that while your assets are with that provider, they actually own the rights to those assets and not you. And it's typically actually the most popular way that at least the terms of service act for many of the largest providers of crypto custody. So if you think about platforms like Celsius that went bankrupt earlier this year, when you put your assets on Celsius, you didn't actually have any claim to those assets once they were in Celsius's possession, because that is how Celsius was able to do things with those assets once they had the rights, so generate the yields for the loans that they were creating. But conversely as well, if you think about even the banks that offer crypto trading now for some customers, like in the UK, we have an app called Revolut. It's also pretty big in Europe. Any assets that you buy with Revolut, so if you can buy Bitcoin, you can buy Ether, you're actually just putting your name attached to a bit of Bitcoin in Revolut's big Bitcoin pile, and you don't own any rights to that. So it also makes it very difficult if you then want to be able to withdraw that Bitcoin and take it somewhere else.
Now, first of all, that seems wild in the sense that when you talk to crypto folks, and especially when you talk to people who describe themselves as Bitcoin maximalists, the idea that you would knowingly, willingly hand over, the right to your crypto seems bonkers. But, Mike, something that you have addressed kind of similar to the idea of, culture is kind of this idea of like convenience, right? It is really hard, actually, to hold on to your own stuff. And so you've got people who are like, one, surely they'll give me back if I ask. 2022 demonstrated not necessarily. And two, well, surely they're not doing anything nefarious with that. Also TBD. So on the podcast that you host with Vildana, What Goes Up, you had a guest, Leah Wald, recently who started talking about cold wallets. Now, cold wallets emerged as this idea of, okay, people may do nefarious things, people may go bust, here's how to keep your keys safe. What is that like in practice?
Well, I think it gets to the heart of the fact that people trust the blockchain itself, especially with Bitcoin. They don't trust all these other intermediaries who are working on top of the blockchain. And I think that's really a lesson that's come back home. There seems to have been a complacency that had grown around the likes of a huge exchange like FTX and all the others. And in practice, it's really getting back to that notion, not your keys, not your coins. People want to hold these private keys somewhere safe, offline. And if you look at the data, there's a website, CryptoQuant, that tracks a whole bunch of things. But one of the things I'm fascinated in is how much Bitcoin is being withdrawn from exchanges and put presumably in cold storage. And in the middle of November, something like $500 million worth of Bitcoin a day, something like 29,000 Bitcoins a day were getting yanked off of exchanges. The problem, though, is that, you put those private keys on a hard drive, and we've all heard the hilariously sad stories of people losing their hard drive, forgetting the password to their hard drive, or, the one poor guy, I think it was in Wales, who threw it out and was trying to bribe the people at the dump to let him go dig around for his hard drive because the value of the Bitcoin had gone up so much. So there are companies that offer this service as well. But I think, this turmoil we've seen in the last month or so has really revived that whole notion of you wanted those private keys as close to possible in as safe a place as possible. And for many, that is simply on a hard drive that you can put in a safe, put in your closet, put wherever. There's a few interesting ones have come out recently, too, regarding NFTs. There's now cold storage wallets where you can store your NFTs, but also show them off to your friends. It looks like a little iPhone. So you can sort of scroll through your NFT collection, but it's in cold storage, meaning it's not connected to the internet. No one can sort of reach in through the internet.
But somebody could steal your little device.
Someone could, yeah. Or you could put it in the dump and have to bribe a trash man to get it back.
So, one of the things I always remind people that in addition to the joke that, we'll kind of make where it's like, haha, underlying technology, crypto is also just tech, right? And so getting people to memorize passwords, very difficult problem. Getting people to back up their hard drives, very difficult problem. Like the number of people in my own family, shout out to my family, who are like, well, I know you said to back up these files, but I didn't. Are they gone forever? And I'm like, oh my God.
Yeah. I could be a member of your family, I feel like.
So you layer on top of, shall we say, the default stance of human beings, which is not to do the right thing when it comes to tech because it's annoying. And then you say, and make that potentially be worth tens of thousands, if not millions of dollars. How do we solve that tension? How are people trying to solve this tension?
I'm not sure you do. And I think what happens is, maybe you put your coins in cold storage when Bitcoin's at $20,000, $30,000, Ethereum's at $3,000, and the prices collapse. And then you kind of forget about them, and then 5 years goes by, 10 years go by, and you go, wait a minute, I'm a Bitcoin millionaire. Where is that hard drive? What is the password? So I think to your point, I think it's human nature. There is no simple, elegant solution for it other than the things you're talking about. Back it up. Don't leave it somewhere in the sun if it's a hard drive. Don't let your kids near it.
Not on a beach in the Bahamas.
Yeah, I mean, it's common sense, but humans, traditionally aren't the best practitioners of common sense. So, the one thing I would say is that when a lot of these coins get moved off the exchanges, it used to be considered a very bullish thing, right? Oh, people are pulling them off the exchanges. That means, well, at least they're not trying to sell them. If you see an influx of coins back onto exchanges, the thinking is, well, they're all getting ready to sell. But I think that signal might be broken at the moment. I don't think you can, assume that because people are so paranoid about every company involved in crypto that it's a bullish thing that they're moving their coins into cold storage. I think it's just survival at this point.
Right. And Emily, you pay a lot of attention to, shall we say, the sentiment, negative or positive, of folks in and around crypto, not just institutional investors, but also, like retail investors on crypto Twitter. What have you observed, to Regan's point, about what folks are doing?
I think the one thing that stood out to me a lot is that in this particular cycle of people moving money back and forth between like cold wallets or online exchange wallets, hot wallets, is that during this period of tumult, a lot of the typical last resort for crypto investors is that it's time to build. It's what you'll hear a lot of companies say during this time is that, okay, no one's trading and everyone's moving their coins off the exchanges. So it's time to figure out how to build something cool so they come back. And in that, one of the top things is how do we make it easier for people to interact with things like cold wallets or interact with things that are on exchanges? Because it's like at the beginning of this episode, we said, it seems crazy. Why would you store your money on an exchange where it's really difficult to get access to it, or you don't own the rights to it? Like, isn't that bonkers? But the reason they do that is because it's really difficult to store it on a cold wallet. You're going to forget your password. Yeah. And so one of the biggest challenges I think that crypto investors talk about is how do we make it more palatable for the masses? Because it's not just that, Bitcoin goes up and down and you might lose all your money. It's also that the digital illiteracy is a thing. And it's not even that you have to be digitally illiterate not to get crypto. You can be incredibly digitally illiterate and still not get crypto.
Well, in traditional finance, TradFi, as it were, the way that folks have solved this is with regulation and legal precedent, right? Like, if you put your money in a bank and the bank goes under up to a certain amount, you will get your dollars back.
Right.
It's not even a kind of a, did Citibank? No.
Right.
So if you had up to $250,000 in the US and the bank goes under, you're going to get your money back. And so I find it a little bit challenging to square this idea of folks in crypto saying we want to make it more palatable for retail investors while simultaneously saying we don't want any additional government interaction with our asset class.
There's a big elephant in the room here in that no one knows legally if a company like FTX files for bankruptcy, where the people who had deposited coins, where they stand in sort of the hierarchy of who gets paid out in a bankruptcy filing. Are they secured creditors? Do they get paid out ahead of non-secured creditors? That hasn't been tested in the bankruptcy courts. And if you read Coinbase's, one of my hobbies is reading risk factors of public companies. If you read Coinbase's risk factors in their SEC filings, they'll say, fingers crossed, they don't really say fingers crossed. I'm adding that, but it's implied that we think in a potential bankruptcy, and no one's saying Coinbase is going to go bankruptcy, but at these risk factors, you have to give every possible dire scenario. And they're saying, in the event of bankruptcy, we think that people who have come to us for custody of their coins, which is not just, mom and pop traders. It could be,
hedge funds, institutional investors,
big time players.
Mm-hmm.
We think that the courts will decide that they will get paid back their crypto holdings. But it's not, it hasn't been really tested and appealed and everything in courts. So no one really knows, as a depositor into one of these exchanges or lenders or any other crypto company, what's to become of those coins in a bankruptcy, how you'll get treated by the bankruptcy court as a client of one of these companies.
I feel like because all roads seem to lead back to Matt Levine somehow when it comes to this, it's very much this isn't actually a trustless ecosystem. Like, the amount of faith you have to have in different things working in order to navigate the system right now seems to be at an all-time high. Up next, more from Bloomberg's Mike Regan and Emily Nicolle on the crypto faithful. Emily, or maybe you, Mike, in your, the time that you've been reporting on crypto, even just in the past 12 months, do you think there's been a shift in the level of kind of aggression around, some very straightforward types of reporting that's happening because the market has gone down because of this collapse of trust? What are you seeing?
Yeah, for sure. I mean, there's kind of two prongs to it, right? In that, on the one hand, the aggression is stemming from now, especially in a post-FTX world, even those at the very top of these companies like Binance CEO CZ say, okay, I'm going to be more proactive in calling out what I think could be fraud, because maybe it'll give everybody the warning signs they needed to have spotted FTX before it happened.
I actually reflect on the FTX situation, and I kind of blame myself for tweeting that too late. I think as an industry, we let FTX got too big before we started questioning some of those things. So I'm taking the approach where we ask questions much earlier.
And that has already resulted in several instances of him tweeting something and then having to delete the tweet because actually it caused more fear and uncertainty and doubt than it was supposed to do the opposite. Mm-hmm. But on the other hand, there's also more aggression around trying to be more stable with what you're putting out there about your own company. But if you're an investor and you have your own portfolio, you want to make sure that the tokens that you hold aren't coming under duress unnecessarily. And so you'll jump in quickly when you hear someone saying something that you think is inaccurate to say, actually, hold on, here's what I think. And the Binance example you gave of the 2 billion is a great example of that, because we see this bot tweet out that 2 billion in Bitcoin is moving, and CZ rapidly says, this is just, us doing something for our auditor who asked us to do it for our proof of reserves. But then we've already heard from others like Mira Cristanto, who works for a digital currency group, saying that actually an auditor would never ask you to do that because that's a financial liability for them. And then you don't really know who to trust, right? And it leaves you in this limbo.
And in a way, I think this all, to me, looks like the market is trying to do what regulators would do if they could wrap their hands around this, which is sort of force some accountability on these companies, force more transparency with proof of reserves. And it reminds me of something we wrote a while ago, that notion of crossing the chasm, going from early adopters who are, comfortable working with private keys and that sort of thing, to sort of a more mainstream adoption where you have these big, centralized exchanges and players, and sort of being forced to mature and provide the type of disclosure, the type of transparency, really build the type of confidence that, decades of regulation did in the TradFi world, is really being forced on them now, not by regulators, but by the market itself, by the players in the market who are like, enough is enough. You need to do this, that, and the other thing to really have our confidence going forward.
Yeah, it reminds me of a phrase in kind of sociology called context collapse, right? Which is what happens when a conversation or a set of idioms move from the people who have a really sophisticated understanding of what's happening into kind of the mainstream. And I really think that a fascinating dynamic in 2022 has been the rate at which, and actually going back to 2021, crypto hit the mainstream on an upswing. It was, Matt Damon and Tom Brady are telling you to buy crypto and buy NFTs, and then it hit the downstream really, really fast at the same time. And folks have a kind of a cultural whiplash, as in, is this thing good? Is this thing bad? Is it the worst thing ever? Is it the best thing ever? I just can't tell. And you don't really get the impression that the industry itself was like prepared to navigate all this.
So you're right, absolutely not. And the due diligence was in a bull market is something that seems to have been deferred. This company's invested in that one. I can trust that they've done the due diligence. No one really seemed to do the homework they should have done, because if you waited too long to do it, you missed out. You missed the rally. So these periods of market destruction can be creative destruction in a way, in that they will cause an outcome where, problems get fixed, confidence restored, one would hope, but, you never know how long it's going to take to sort of really get it back into the full swing of things like we saw in 2021.
All right. Well, thank you both for being on the show.
Thank you.
Thank you.
You can find more of Mike Regan and Emily Nicolle's work on the Bloomberg terminal and on Bloomberg.com. And of course, check out Mike's podcast that he hosts with friend of the show, Vildana, called What Goes Up. This is Bloomberg Crypto, a daily podcast from Bloomberg and iHeartRadio. For more shows from iHeartRadio, visit the iHeartRadio app, Apple Podcasts, or wherever you get your podcasts. Send us your comments, questions, or suggestions for the show to crypto@bloomberg.net. The supervising producer of Bloomberg Crypto is Vicky Vergolina. Our senior producer is Janet Babin. Our producers are Mohammed Farouk and Sharon Barrero. Our associate producers are Ty Butler and Moses Undum. Desta Wonderad is our engineer. Original music by Leo Sidran. I'm Stacey Marie Ishmael. We'll be back tomorrow.